Welcome to the Emotional Balance Sheet, the financial planning podcast for parents who are senior level professionals with kids in school or college. If you're tired of stitching together 4 different specialists to run your financial life, you're in the right place. I'm Paul Fenner, certified financial planner, enrolled agent, and founder of Tama Capital. I also have 4 kids, including a set of triplets, so I know the pace. Let's get into today's conversation.
Hi, and welcome back. This is going to be a different kind of episode this week. I'm going to talk about a piece of paper most people haven't looked at in years. Back in May, I did something for every family I work with. I pulled up the current beneficiary designations on every account I had on record. The IRAs, 401ks, individual accounts with TOD designations, HSAs, the full list that I had. Then I sent an email that said, here's what accounts currently say about who gets your assets. Please read this carefully. That email had the highest response rate of any Tama family email I sent this year. For some families, everything was already clean and the response was a one-liner, everything looks good, which is great. But for other families, there were gaps that we needed to address sooner rather than later. And a lot of families responded with some version of, I had no idea I hadn't updated this since 2019, but thank you for paying attention. And that's what I want to walk through. What's actually on those forms? What goes wrong? And why this is one of the most underrated areas of financial planning for busy working families. Your beneficiary designations on a retirement account or a life insurance policy overrides what's in your will. If your will says your assets go to your current spouse and your 401k at a previous employer 5, 6, 7, 10 plus years ago still list your ex-spouse as your primary beneficiary, those 401k assets go to your ex-spouse. The will doesn't fix that. The lawyer doesn't fix it. The executor doesn't fix it. The custodian sends the money to whoever is on that form. And this is not a small technical detail. This is the single most common source of an estate disaster I see within my firm. Someone meticulously updates their will after a remarriage or a divorce, but never touches their beneficiary forms. And the wrong person inherits a meaningful piece of that net worth. So let me walk through a few more gaps that I often see. One is a deceased parent is still listed as the primary beneficiary on a Roth IRA opened in someone's 20s. Mom passed away 7 years ago. The form never got touched. Second, there's no contingent beneficiary. This one's really important, especially if you have kids. If the primary beneficiary predeceases the account owner, the assets fall to the estate. So for a retirement account, that usually means probate. Plus worse, tax treatment that nearly any other distribution path does not involve. A third one I see, the 401k at the previous employer has a completely different beneficiary structure than the current 401k. Most people leave a job, the old 401k just sits there and they never look back. The old account got set up when they were single and their parents were healthy. And now times have changed. Fourth, the HSA has no beneficiary on file at all, just defaulted to this state. And I'll come back to that in a minute on why that's a bad decision. And finally, and as I mentioned earlier, an ex-spouse is still listed as a primary beneficiary on a previous employer account. The divorce happened years ago. The quadro got handled, but somehow the beneficiary form got missed. So if your retirement account is a 401k and you're married, ERISA, which is a federal agency, requires your spouse to be the automatic primary beneficiary. You can name someone else, but you need notarized written consent from your spouse to be able to change it. And this constantly trips up second marriages or blended families. The person filling out the form intends to leave the account to children from a first marriage, but doesn't know about the spousal consent required, and the form is technically invalid. So if you have a retirement account that's an IRA, ERISA does not apply. State law does. You can name whoever you want as a primary beneficiary, and your spouse has no automatic claim through community property states. That adds a little bit of a wrinkle, but we're not going to go into that today. But many people don't realize that 401ks and IRAs play by different rules. Next is the HSA potential tax bomb. So if you have an HSA and you leave it to your spouse, it transfers tax-free and remains fully tax advantage in their name, which is great. But if you leave it to a non-spouse, the day you die, the HSA stops being an HSA, and the entire fair market value becomes ordinary income to the beneficiary that year. So if you've spent 20 years funding an HSA as a retirement asset, which I encourage most families to do, and you have $150,000 in it, leaving it to your adult children can produce a $40,000 to $50,000 federal dollar tax bill in a single year, depending on their tax bracket. There's a 1 year window where not paying unpaid medical expenses from the account can help, but most beneficiaries don't know about that rule and miss the deadline anyways. This is why for married couples, when both spouses are still alive and healthy, the spouse should be the primary beneficiary of the HSA almost without exception. And it's why naming the estate as a beneficiary is like the worst of the three outcomes. A second, or I guess third point I wanted to bring up is the stretch IRA rule. If you are an account owner who passed away, your required minimum distributions begin at age 73. And if you elect a non-beneficiary spouse, which is to say like most adult children, this thing called the Secure Act 2.0, this 10-year rule is now fully enforced the year that you take over those assets. So the inherited assets, the inherited IRA, must be emptied by the end of the 10th year after the date of death that you took over the accounts. And if the person was already taking a required minimum distribution, you or the adult child in this case must continue to take RMDs as well through year 9. But again, that account has to be fully depleted by the end of year 10. The old stretch IRA planning where you could take small distributions over your lifetime, it's gone for most cases. So what does this mean in practice? If you are 60 years old and you have, say, $2 million in traditional IRAs, and you have 2 children in their 30s earning, $200,000 plus a year, the structure of how that money gets distributed after your death has gotten meaningfully worse from a tax standpoint. So the math on a Roth conversion changes. The math on charitable beneficiary changes. The math on which kid gets named on which account changes. So these are not decisions you make from the beneficiary form alone, but the form is where those decisions ultimately land. One other point I want to address when it comes to this beneficiary form is per stirpes and per capita. On most beneficiary forms, there's a small box. It's often easy to miss for per stirpes or per capita, and most people skip it. But I want to explain what it means. Say you name 3 children as equal primary beneficiaries. One of them passes away before you, leaving 2 grandchildren behind. But if you elected per stirpes, that child's 1/3 share passes to their 2 children. But if you elected per capita, that 1/3 share gets redistributed equally among your surviving children. So 50-50, but your grandchildren receive nothing. For most, senior professional level families with multiple kids, per stirpes is what they actually want. The form often defaults the other way or leaves it blank, which usually triggers the per capita default. And that's what you probably want to avoid. The single most useful thing I do for the families I work with on this topic is to treat the beneficiary review as a calendar item rather than a triggering event. Let me kind of unpack that a little bit better. Most people think they'll update beneficiaries when they have a life event. Baby's born, marriage, death, divorce. The problem with that mental model is that life events are exactly when people don't have the bandwidth to update beneficiaries. A death in the family is not when you're going to log in and change your old employer's 401k and update a contingent beneficiary form. So once a year on a fixed cadence, I pull the current designations for every account I track for the families I work with and send it to them in plain English. They read it, they tell me what's wrong, and we fix it. That's it. There's no philosophy in this. It's just sitting down and reading the document. Morgan Housel, who I often quote in the podcast, once wrote that doing well with money has little to do with how smart you are and a lot to do with how you behave. And the piece of the behavior we don't talk about enough is this boring kind, reading a 1-page form once a year. 20 years in the running TAMA, the behavior that has saved my families the most money on the estate side is not a market decision, it's a paperwork decision. So remember, money is a number, enough is a story. Make sure you're writing your own. And if you're a working parent and this conversation resonated with you, I'm working with new families at TAMA. You can go to tamacapital.com to schedule a conversation or click on the link in the show notes. That's it for this week. We'll see you next time. Now for the fine print. This podcast is for educational purposes only and is not personalized financial, tax, or legal advice. Before making any decisions about your specific situation, please work with a qualified professional. TAMA Capital is a registered investment advisor.